confirm when it's live streaming for you.
Don't forget to record. Thank you.
Thank you. Welcome everybody. I'll just fill in until Lyndall comes as Deputy Chairman. So welcome to the Organisational Performance and Audit Committee. Welcome, Bruce. Good to see you back.
Great to be here.
Welcome to staff that are with us today to help us through quite extensive papers, and we've got some matters that need attending to. Thank you, Tanya, for your updated commentary, and you'll take us through that in due time. So is there any apologies? Apart from Lyndall being late.
Apologies for lateness. I'll move Lyndall's apology for lateness.
I'll second that.
And Bruce, thank you for that. All those in favour, please say aye.
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 Right. Okay. And against? Carried. Thank you. Declarations of interest. Any declarations of interest that people want to make us aware of? There being none, we'll move on to public forums, petitions and deputations. Item 4, I'm not aware of any. I haven't been told of any. Jan, are you aware of any?
No.
I'll take that as a no. So we'll move on to item 5, confirmation of minutes on the 9th of February. We have somebody to move them.
I'll move that, Lloyd.
Bruce and Jeremy, thank you. Any alterations, clarifications or anything under accuracy? There being none, we'll put any discussion on that, and I will just put the minutes up. All those in favour, please say aye.
Aye.
And against? That's carried, thank you. Item 6, notification of extraordinary urgent business. Or any supplementary reports. Is there anything? There's not. Any questions? I'm not aware of any questions. The only question I have is that everybody has read the updated, thank you, Lyndall, updated a report from Tanya. Okay, we'll take that as right. And number 8, Chairman and Councillors reports. There's none showing. So Lyndall, I'll hand back to you. We're on 9, item 1 under general corporate reports. Your mute's on, Lyndall.
Yeah, sorry, I've got the phone going and all sorts. So thanks for getting us started, Lloyd, amidst all the short notice. In response to the desire to keep track of items that pop up during discussions, we're going to endeavour to have, as part of my chairman's report, any follow-up and check-in on progress. Today's will be verbal, but and we'll see how that goes. But in the longer term, we are hoping that will be a written report, just to in the form of a kind of like an action sheet, just to keep you abreast of where we're at with any of the things that needed following up. So bear with me while I cover off 2 or 3 of those things from our last meeting, which was a risk meeting on the 9th of February. So from those, you'll have noticed already that future updates to committee agendas were to be included to avoid confusion, and we've actually, hot on the heels of that, had that happen this time. So you all got an explanation for that, and you should have, as Lloyd's just asked, you should have seen the updated version. I'll cover off the exact wording change in that when we get to that to help Tanya out, but appreciate that came through. Thanks very much. Item 2 was information management systems, technology and data update. Councillors were to receive an update on the external information management strategy review. This will be presented once the review of the IM and IT strategies has been developed. No date on that yet, but I'm sure we'll get one. Councillors are to be included in the privacy policy training, and that has been scheduled for May, along with cyber security training. Item 4 was the annual activity plan. Future changes to the activity plan to be indicated in colour, and you will see that that has happened. So well done. Further changes include the age data report to be amended to appear on the 24th of May 2022, which has been done. Executive were to discuss the program of work, including the committee, which this should fall under. Some changes have been made as a result of this item, and more conversations are to be had. Deloitte to present their annual audit plan at the next OPAC meeting. Magic. Planning for the annual report to be signed before the end of the triennium, including any forward planning, is in progress. And the fund manager review to be completed by October 2022 is in progress. That's it for the public session of the previous meetings. So I hope that keeps you abreast of where we're at with some of those requests from the committee. And in future, that will be recorded so that you have got some time to get your head around all of those things. But and fantastic to have so many of those things ticked off in a very short space of time. So thanks to the team for making those requests and those recommendations happen so quickly under busy circumstances. So I guess I need to move that somebody that we accept my report, please. I will move that if somebody would like to second, please. Thanks, Ellen. All those in favour, please say aye. Raise a hand. Thanks. Against? And carried. Thank you. Just because I didn't open the meeting, can I just ask you, please, when we're in, a multifaceted discussion, can you please use the reactions hand up from the bottom of your screen? Because when you raise your hand virtually like that, it pops you to the front of the screen. So when there's a lot of faces, it organises you in the order that you've put your hand up, and for me, top left, heading right. So then I'm less likely to miss you. And please remember to take it down once you've had your say. That'd be great. We'll see how that goes. Thank you, Jeremy, for the thumbs up. Appreciate it. Right. Item 9 is the General Manager's report. Item 1, the financial report. Tania, would you like me, before you start, to just highlight those changes that you made in the new version?
Yes, please, Chair.
Sure. So, hoping I've got it right. So the first sentence was deleted, and the second sentence was changed to read, the operating deficit for the financial year is forecast to be 4.7 million versus a budgeted deficit of 6.7 million, an improvement of 2 million. Okay, and the last sentence that is added is in the final sentence on page 12 is not the final sentence, there's another one. This is it. Council is forecasting a full year surplus of $524,000 ahead of budget. Okay, so if you haven't got that version in front of you, that's what it should be. Tania, is that correct?
Yes, thank you, Chair.
Great, I will hand to you to present that first item. Thanks.
Thank you. Would the committee be happy if I was to share my screen so we can highlight I'm a lesson in trying to spotlight. I had worked this out perfectly, the days you don't need it. Not working for me. Somebody might like to help me. I did manage to get that to work the other day, Chair. So we will, I'll use can you see my highlighter here? So we'll start with the line that we always start with, which is operating surplus. for the 6 months ended December, there's a positive variance of $3 million. We are forecasting that to change by the end of the year to 1.9 million. Now, the positive variance is made up of an income above budget of 932,000, which is a combination of rates, penalties being higher, increase in our fees and contributions, local contributions, and a LIDAR contract not being in our original budget. So it's a combination of many things. It's not one particular thing. By the end of the year, we expect that to have reduced to be 500,000 above budget. The big ticket items here are people and operational expenses. As we've indicated in the first quarter, the vacancies have I won't say vacancies have continued. The percentage of vacancies remained a bit higher than we expected, and as a result, we still have a variance of 788,000. And we do expect that to actually hold through to the end of the year. When we look at the fact that we won't be travelling as much, if at all, we won't be going to any of those conferences and things and that we might have been going to, which of course reduces our budget again. On top of that, there was quite a drawdown of annual leave in January. So we expect the end of the year we'll have a positive variance still, and people, contractors and consultants is actually very close to budget relative to where we've been in the past. And in previous times, 6 months, we might have been a bit under budget. We're actually much closer to budget. And when we look at both the contractors and operational costs and look at the physical works within both of those, we'll see that some of our guys have been obviously out there and been able to do more work than they have in the past. The operational expenses that were $1 million favourable here, a variety of things, but there's two main items. One is our transformation budget, which is a technology-based spend, is slower to be spent, I suppose, is the simple way of saying that. And our grant contributions it's just a timing difference there. However, by the end of the year, we expect that we'll still have a $800,000 positive variance. There'll be funds not yet spent at the end of the year. We then come down to the investment income for 110,000 ahead in our interest and dividends at this point. We expect that actually won't continue, that we'll end the year with around that 2% on funds invested as our income. This here though, this unrealized income, or in this case loss, that's the movement in the capital value of the portfolio. And you'll be aware that as a result of what's happening in Europe, actually prior to that, increase in interest rates, increase in inflation was certainly putting some downward pressure on our portfolio. But to add to it, the last, I suppose, part was the recent invasion of Ukraine, and it's seen a substantial drop in the market there. That's actually, today it's 500,000 lower again than what's shown there. So we need to net these two numbers off to understand where the portfolio is. But as I say, it's down again. However, I'd like to bring up while we're here, and I know we're not in the investment meeting, that it's not all bad. So we'll cover that off in the investment report. Government funded projects are showing a surplus ahead of budget. Some delays in expenditure and delays in work there in the climate resilience project, and a large piece of work for Wilding Pines, majority of that had started after December, so you would have seen it come through in the council meeting. Work has in the summer months, January, February. Put together, there's a surplus of $11 million versus a budget of $6 million. Forecast, though, the key number here is where are we going to end at the end of the year, and that is 7.4 versus 6.8. So $500,000 or $600,000, 524,000 ahead at the end of the year is our forecast. Now, apologies for the fact that the commentary was out of sync with that. Before I go to the next page, Chair, shall we take questions?
Any questions? Okay, carry on.
So the next page we have is actually the same numbers, but with the emphasis on the portfolios. What are our groups of activities? How have these been affected by those changing numbers? And I won't labour this actually, Chair. I'll ask if there's any questions on this page. We've been through these before. Is there anything that council would like answered? If not, I can move on. So our balance sheet, 20.6 million in cash at the end of December. We can talk about that further when we talk about the cash flow. Trade and receivables, when we look at the debtors reports, you'll see that our overdue debt, well, our overdue rates is higher than this time last year. And statement of cash flows looking healthy and very similar to the previous years. Significant expenditure projects, climate resilience. We have received, as you can see, half the money. Haven't been able to get that same amount of work done. So we're sitting with a balance, including council's contribution and the government contribution, sitting with funds available to continue the work. Biodiversity projects similarly. With Wilding Pines, we tend to get a lot of the money in advance, start the work seasonally. So quite a bit of money sitting there available for those projects. Capital expenditure, major projects. Any questions on this page, Chair?
Nobody's got their hand up.
I think Ellen raised his hand.
Ellen has. Thanks, Ellen. Unmute yourself, please.
Yes, there we go. So just questioning, our assets are up $2 million, property, plant and equipment. And on a cash flow basis, we've only seemed to have spent $1 million.
The only answer I've got the councillors, I believe it'll be capital work in progress. But I can follow up if you're keen for me to understand that. Yeah. All right, thank you. Would you like me to come back to you on that? Yeah, just I guess, yeah, just how I thought that there would be there should be, unless it's an accrual basis, or you're right, you've already somewhere had that other million on your balance sheet in another location. There should definitely be a connection between the growth in your property, plant and equipment, and at a similar amounts to what you have spent under purchase of property, plant and equipment. Yeah, absolutely. I'm sorry, I don't have that information just to hand. I'm not doing the journals, but I will follow that up for you.
Thanks, Tony.
Council activity report, again, excluding government funded, 52 of our levels of service are in green, high level of confidence they'll be completed, 2 and 2, and Rachel will talk to the details of those in the LTP report. We show here the combination of how we're going financially and how we're going with our levels of service. See that people here showing just below budget, operations and contractors. Physical representation of what you've seen before. And we look at the groups of activities, air quality has the 1 medium. Only 21% of budget spent at 31st of December on air quality. This time, Chair, I have changed the graphs to all have the same axes, so that when we look through them, we're looking at comparatively how much we're spending in each group. I found last time that they were automatically changing and it wasn't reflecting really. So quite an insignificant amount, if I'm allowed to say that, here for the 6 months in the ongoing work there. And obviously it's in the science strategy and investigation, which is our monitoring area. So one indicator to be discussed as we go through the home heating review. Biosecurity and biodiversity, 12 positive levels of service, 50% expenditure, so everything's fairly well on track there. Climate change and climate resilience, 8 and 2 to be discussed. Not far away from budget actually as well. Coast and marine, pretty much on target for expenditure, 7 and 1. And the coastal partnership plan here to be perhaps talked about maybe. Regional leadership. So this is one that's probably on the underspend side as a result of our underspend in total, and you can see in consents, community engagement, and council members, policy and planning, everything's just a little bit under there. The cumulative effect of that is this 900,000 not yet spent in the regional leadership group. This one here is the timing thing. This is about grants and contributions. Actually, our strategy and partnership group make a lot of the grants on behalf of the council. And the rest is actually to do with vacancies throughout the 6 months. Wood and land, again showing some underspend there, or delayed expenditure I should say more correctly, and that is sitting largely in the laws team. And again, you might have reading through the reports, the laws team's been rebuilding the team and expanding the team over the last 6 months, but all indicators on track. And that's that report, Chair.
Thanks, Tanya. Any questions? Lloyd, you have your hand up. Well done.
Right. Learning technology, Madam Chair. Tanya, it would appear to me as if, I'll just take that, press it again, oh, right hand, no, I don't know. It would appear to me as if we're pretty much where, well, actually, we're probably a bit better than what we have been previous years. We're probably more on target apart from a couple of critical ones. So are we getting better there at understanding our business in some respects? Yeah.
Well, that is hard to answer that question, Councillor, because we try very hard to get it right. The season has certainly helped us in terms of our physical works being able to be done. We review the budgets each year to try and improve the timing of the budgeting, and the business planning that we're doing is helping us. But yeah, I'm happy, I'm happy with where we're at. It's on the right side of the ledger is the most important thing, I think. And we've got a good process in place to help us with the forecasting. We will reforecast in April, well, the end of April for the end of the year, and see where how this quarter's gone. And it's very difficult, of course, even for the managers to forecast given all the challenges around work. But I feel that our reports,
so
are
let me,
accurately.
right. So let me follow on because I think it looks better. So what are there some risks that we're going to find or surprises that are coming up at the end of the year or by the end of the year that may change? And don't worry about the 2 red ones, we'll talk about them later, but is some of the green ones got difficulty going forward, or are we expecting difficulty with some of the COVID stuff coming at us? Is there any risks around that?
I think there must be, but I don't. when I say that, I think I'm just being cautious. I'm not familiar with each of those indicators, and I believe Rachel will be in the best place to answer that. She's actually had conversations with the owners of those levels of service, and she'll be able to talk through how they're finding it, progress on those at the moment. I'm not trying to deflect, I'm just suggesting she's the best person to answer. In terms of the budget, we're doing the same thing within finance. We're talking to the budget holders and checking in, how do they think they're going? How do they see themselves placed? And they were quite positive, I've got to say, they always are. But the next quarter will be the one when we really know if there's been an impact on us from this situation we're in at the moment.
Rachel, would you like to comment quickly, or do you want to save that for later?
I was just going to ask you the same question, Chair. Very happy to comment now, or just to save that commentary to the LTP progress report.
Yeah, we might save it till then, actually. And Lloyd, I like to think that maybe the reporting that we're getting is better, more specific. So maybe that's why it's starting to all look more cohesive. Councillor Beard.
Yeah, thanks, Madam Chair. So just on, I'm looking at the government funded projects, and so obviously we are still projecting to get the revenue that we thought we would. Obviously, we're aligning our forecast with our budget. If our spending is off, as in we're behind with some of our where we were at with the milestones on our government funded projects, are they obliged to fund us for the next part of the work? So are we certain that we'll pick up the forecasted revenue even if we haven't perhaps made the milestones, or are we still predicting to make the milestones?
So the project plan that I have says that we are doing our best to make those milestones. The money comes in as we achieve them. There's no risk here so if we don't spend the money, or if we don't have a project that meets the milestones, we don't get the money. But at the same time, there's no risk to us because we haven't spent it. So any delay delays the expenditure and the income. So yes, I've projected that we will get the income at the end of the year, but we're also projected we'll get the expenses.
But there's a surplus of 8.4 million, which probably is quite helpful for our cash flow.
That's a paper surplus. That's a capital profit only based on the fact that we get the money and pay it into a capital, assets. So it's not that 8.4 million. I'm sorry, is not actually a cash profit for us.
I appreciate we've got profit and we've got cash flow though. So it's how we use the money that comes in. Because
they're not paying us substantially in advance, they're only paying us as we need it. It's not even the only benefit, Councillor, to that money is that we are supposed to get it ahead of expending it. And when we get to the debtors report, you'll see that actually hasn't proven to be the case either. So
it's more how you've done your 12-month cash flow that I was inquiring.
Yes. So when we get to the cash flow, we can have a look at that. Yeah.
That's fine. Thank you.
Chair, if there's somebody in the waiting room wanting to talk to us about the investment report, if there's no other questions, could I quickly go through the investment report?
We better move that recommendation first.
Yes.
Yep. Somebody like to move that? Thanks, Councillor McCallum. Seconded, Chairman Horrell. All those in favour, raise a hand. Thank you. Against? Carried. Thank you. Right, we'll swiftly move to the investment report while I shuffle pages. And I'd like to welcome Tom Phillips. Are you there, Tom?
I am, Madam Chairman. How are you?
Thank you. Great. And do you have company?
Well, I don't have company in the room with me, but I've got Phil Borkin and Bruce Robertson should also be somewhere in the wonderful world of Zoom.
Oh, see, that's very confusing. We've got two Bruce Robertsons in the house.
It's Bruce from Auckland. Bruce from Auckland. Good afternoon.
Welcome. Thanks very much for your time, gentlemen. Tanya, do you want to introduce the item or?
Thank you, Chair. We have these gentlemen here to update us on what's happening with our portfolio. It was on our agenda to do so. It's probably more timely than ever, in fact. So we'll, I think we'll listen to our guests and then we'll go to the item and go through the formal process after that, given that they're here and ready to go.
Fantastic. Councillors, can I just remind you to hold your questions till the end, please? And I'm assuming that you have all read everything, so the gentleman can cut straight to the chase, please. Thanks.
You're welcome, and you lead it off, Bruce and Tom.
Okay.
To the figures.
Thanks, Tanya. Madam Chair, just before we start, I see there's 30 minutes allocated. Should we look to speak for perhaps 20 and allow 10 for Q&A at the end?
Or the other way around?
Okay, we'll do a quick 10 minutes and 20 minutes of questions, far better. Look, thanks for having us here. As we were, preparing for today's session, I reflected that every time we give you an update, it always seems to be a period of heightened volatility. I distinctly remember a call 2 years ago, almost to the day, when we sat here with you, and I think I made the projection that we'd be all working from home within a week. And the chaps in the room said I shouldn't have been so doomsday, and then I think it was literally the next day that the Prime Minister sent us all home. So, I guess the message from that is, in the 2 years since that, the world hasn't fallen apart, and we don't think it will this time either. But we'll tell you in the next 10 minutes why we don't think that's the case, and then I'm sure we'll get some more interesting questions. I assume you've got the document in front of you. So if I just look at the performance on page 3. So these figures are run to the end of January. I know the update's to the end of December, but we've tried to do it as recent as possible. Essentially, we've got a flat return for the first 7 months of the financial year. Perhaps if we just look at page 4 there, which drills into a bit more detail on each asset class. Again, you can see the portfolio flat. And I get the key point to us is the bullet point at the bottom of that page, which is Environment Southland's primary return objective as per the SIPO, which is essentially to exceed the risk-free rate, which is defined as the 5-year New Zealand Government Stock Index by 3% per annum over a rolling 5-year period. So calculating those numbers, the rolling 5-year return for the portfolio is about 53%, or roughly about 9% per annum over the last 5 years. Exceeding that target objective by about 5.5% per annum. And I guess our view is that we think the portfolio remains well positioned to continue to achieve and exceed that going forward. Just in terms of what we've done over the past sort of year since we perhaps last had a catch up, was we had an overweight to growth assets or shares over that period, and that enabled us to reap a lot of those positive gains in equity markets that we saw over the first half of last year. We pulled that overweight off in the middle of 2021, and we've gone to more of a neutral asset allocation. Top of page 5 just shows where we are now. Broadly speaking, we're neutral in terms of we've got 50% weighting to cash and fixed interest and a 50% weighting to growth assets or shares. Within our income or our defensive part of the portfolio, we're overweight cash and underweight New Zealand fixed interest. And the simple reason for that is we see the Reserve Bank starting to tighten interest rates progressively over the course of this year and next year. And so we'd rather be long cash, which enables us to take advantage of better fixed interest opportunities we see presenting themselves over the coming months than simply have money locked away, potentially earning low interest rates. In the equity space, we're underweight listed property because we see the evaluation stretched relative to their net asset values. We've got a slight overweight to global equities, where we see on a valuation basis they present better opportunities than perhaps the domestic market does here. Just a quick comment there on page 6 of responsible investing. So Council obviously has a responsible investing policy, which we follow, and it's broadly similar to the super fund exclusion policy, adult entertainment, controversial weapons, and tobacco. And so we continue to monitor the portfolio against those, and we confirm there is no breaches. I'll maybe just hand over to Phil and Bruce now, just to talk onto slide 8 here, just a bit of a summary of the sort of macro position where the world is at the moment and where we see the next 6 to 12 months for the portfolio.
Thanks, Tom. Hi, everyone. Good to speak to you again. Look, I'll largely take the slides as read because, conscious of time, and there's quite a bit in there. But look, clearly there's some really big issues going on around markets at the moment. We've had a very turbulent start to the year, initially on inflation concerns and central bank concerns, and now the more pressing narratives clearly around the Eastern Europe situation. It's clearly pretty tragic. Look, I certainly can't sit here and say how I know the crisis will evolve. The situation's highly fluid. And it is unfortunate when I'm in this type of position as an investment strategist to view these kind of really tragic outcomes and try and make investment decisions around them, because you kind of can get washed up and feeling pretty morbid about the whole situation. But what I would say is clearly the main channel with which this could broaden and become a bigger, wider economic problem than just in Eastern Europe is clearly through commodity prices and energy. And if you do have the slides in front of you, just there on page 9, you can see that's particularly relevant for Europe. Europe is a big client of Russia, and Russia is a big supplier of energy to Europe. And at the moment, apart from the developments overnight where the US did signal that it's going to ban oil from Russian oil, which is kind of really at the margin more than anything, direct sanctions on energy, Russian energy, have been pretty limited. And so in that regard, we still believe the base case is that the situation will be contained and it won't escalate further. But as I mentioned, the situation is very, very uncertain. What I would also say, and this again, not to dismiss the risks or be flippant with regards to the human tragedy that's unfolding really, is that history very, very often, in fact, it's incredibly rare for geopolitical crises to cause wider economic damage, so a recession, in other words. Usually you need far bigger macro forces at play. And so you can see there on that right-hand chart of page 9 there, how at least the US equity market has behaved around geopolitical crises in the past, or military conflicts in the past. And the impact is large, sharp, but more often than not, very, very short-lived. And so again, not to come across as morbid, but more often than not, for investors, these crises, given the risk premium that gets priced into markets, they actually present opportunities more than anything. But notwithstanding that, clearly there's risks, and the risks unfortunately look like there's still chance that it escalates further. But like I said, I think the most important point to realize is that in themselves, geopolitics very rarely causes recessions. Bigger forces need to be in play, and clearly at the moment there are bigger forces, and the biggest one, and it was the biggest one prior to this latest conflict, is around the inflation backdrop. And if we just jump forward a couple of slides on page 11, inflation, if we go back since the day dot of the pandemic and think about how it's progressed from an economic perspective, at least, I think probably the biggest surprise is the ability of the world to produce vaccines so quickly, and effective vaccines, more or less at that. But the biggest economic surprise has been the magnitude and speed at which inflation has emerged. That's caught everyone, well, 90% of commentators at least, including central banks, off guard. And they're now obviously changing their rhetoric around what they need to do to respond to that. And we're seeing them pivot quite quickly to either start withdrawing stimulus or signaling that they're not far away from withdrawing stimulus. And that has been, was the biggest kind of cause of the turbulence we've seen in markets this year. The biggest question for investors then, given where inflation is, given where policy is coming from, is will central banks be able to engineer a soft landing. So in that jargon, it basically means, can they get inflation down to a more comfortable level without slamming the brakes on the economy, the global economy, I mean by that. So do they have to tighten so aggressively that they effectively cause a recession at some point in the future? If that is the case, then you get nervous about your growth exposures, your equities exposures in that environment. Or are they able to get inflation down and the growth backdrop holds together? Because that situation is still very favorable for equities, especially relative to other asset classes. And look, it's fair to say that our base case is very much the latter still. We believe that, yes, inflation is high. Yes, the risks are that it stays high for some time, but we don't believe that central banks are going to respond in a way that causes kind of very severe damage to economies. And we say that, and I think this chart gets lost, I think, in a lot of the normal commentary around inflation, particularly in New Zealand at the moment. But that chart on the top of page 11 shows where the majority, this is for the US, but it's a case around the world where the majority of the inflation has come from in the last 12 months. A lot of it has been energy, absolutely, and that is going to remain the case, I think, while this conflict in the Ukraine lingers. But outside of that, the majority of inflation actually has been in durable goods. And this is a category of consumption which for the last 20 years, prices have been falling. So this is furniture, this is electronics, this is cars. This is the stuff that you need to produce in a factory, put on a ship, put in a truck, and it's very trade and commodity intensive. That's the majority of where the inflation has come from. And it's been a case of people have been locked at home, their incomes have still been more or less okay, but they haven't been able to go out to restaurants or to travel or to go to the cinema. So they've been spending on other things, and it's been these durable goods that have kind of, well, from a consumption sense, benefited from that, but the prices have gone through the roof, and it's caused all these supply chain problems around the world. Our belief is that those will not last forever, that we will eventually see a normalization in household spending. Once restrictions are removed, people will go out spending on services again. And once you've bought a new washing machine, you're very unlikely to buy another washing machine again the year later. So that spending will normalize. And as COVID eventually moves into the rearview mirror, hopefully sooner rather than later, that again, the restrictions on labor and supply chains will eventually ease, and you'll see some of these price pressures come off. Now, for central banks, that's a big assist that they're going to get from that. And it doesn't matter where they set monetary policy, that will happen by itself. So we think that inflation pressures will ease off naturally to some degree because of that. And again, central banks don't have to necessarily hike aggressively enough to damage growth. The other point we'd make, and if we just jump through to page 13, I think this is very, very important as well. And I get apologies, the lines on this chart are actually around the wrong way. But inflation expectations over a long term, so this is kind of looking out 5-10 years ahead, are still very anchored relative to history. So businesses and households are looking at the next 12 months and thinking, yeah, look, prices are going to stay, and inflation, is going to stay elevated for a while yet. And because of that, I probably want my wage check to go up accordingly. So that is a risk for the inflation outlook. But at the moment, most households and businesses see it as just a temporary factor, and over the long term, inflation will stay kind of around that 2 to 3% level. So that's another argument to suggest that central banks aren't losing control here. Yes, there are risks to the upside, but over the long term, inflation expectations are still anchored. And again, consistent with an argument that a soft landing is still the base case. So look, I'm conscious of time, and I know there's no doubt going to be questions. So look, our views, just very quickly to summarize that, watching the Ukrainian situation very, very closely. Very difficult to make asset allocation decisions on it, because if it de-escalates, which is possible, I think you'll see risk premium priced out of markets very quickly. So in other words, equities, and things will rebound very, very sharply. So we're reluctant to make a bold asset allocation decision on that. What we're far more focused on from a positioning sense is the inflation outlook and how central banks respond to that. And at the moment, our base case is soft landing, hence still happy having exposure or a neutral exposure to equities relative to target. If we start to become more concerned that inflation is going to last a lot longer, that inflation expectations are becoming unanchored and central banks are going to have to get far more aggressive, then that is a situation where you'd look to reduce your equities exposure. But that is not our base case at the moment. So look, I'll pause there, and unless Tom or Bruce have any other comments, I'll hand back to you, Madam Chair.
Tom, Bruce, any comments from you before I open for questions?
No, I think Phil summed it up. Just the key point again for us is always your investment horizon, because I always highlight that to have strong equity returns, which we've had over the last few years, you need to have these corrections. And look, this is an ugly correction. It's going to be ugly, I think, for 6 months. And I don't want to take anything away from Phil, but we are all guessing in the short term. The biggest factor, I think, is that we will see this inflation hang around a bit longer than we will like. And while a lot of investors want to go to cash and it feels safe, I think they're delusional when you've got inflation running at somewhere between, I'll say, 7 and 11%, and you're going to be sitting in cash. So it feels safe, but it's not. You're going to be going backwards. And equities and property are still going to return real returns over the near term, maybe the medium term. So the key for us is always about your investment horizon. And the second thing is that we always have available to you the cash flow when you need it. And that's the key point for you as well. So I think, Phil, you've covered off all the deep stuff, but that's the points I'd like to bring to the table as well.
Thanks very much, Bruce. I have Chairman Horrell with his hand up. Thank you.
Yes, it's disappeared again, but it's just I'm interested in your inflationary projections and hearing those numbers that you just mentioned. We haven't seen inflation numbers like that for quite some time. You've got, if the fuel prices stay up, if labour markets are tight, and the uncertainty in the Middle East, I'm just wondering about that time frame. It's and of course we've had central banks who've been printing money during the COVID event, and I'm just interested that you think it's a short-term spike.
Well, I don't believe inflation is going to stay, like if you look at the US and where New Zealand's likely to print, going to stay at 7%. Does it ease back to 3.5? Probably, and that's higher than what we've faced if you look back over the last 15 years, where inflation in New Zealand struggled to get to 2. I think under Graham Wheeler, it never, his preferred measure of underlying inflation never ever hit 2%, and he tried tightening a couple of times through that period and had to reverse that. So do I believe inflation is going to stay as elevated as today? No, because of the views around an easing in supply chains. Is it going to settle at a higher level than what it has over the last 15 years? I think that's probably a safe assumption to make. But that's still a backdrop where 2 to 3% inflation is still okay as an investor relative to 0 to 2, which is what it was over the past 15 years. Because if you think about Europe's need to transition away from Russia for energy, the need for the world to decarbonize, it's going to have costs. You've got your globalization seems to have peaked, and there's all these forces which have kept inflation so low over the last couple of decades. They're not quite so apparent now. So yeah, I think inflation will average higher than it has previously, but highly convicted that it won't stay at these levels forever, given what has driven it there. Now, where are the risks skewed to that view? The risks are skewed that it stays more elevated in the near term, given the geopolitical situation, which, like I said, I have no visibility over in the near term, given the tightness of labour markets, things. So that doesn't argue that central banks don't need to tighten. I think they do, and they will, and some already have, clearly in this part of the world. What it argues is that they don't need to tighten any more aggressively than what's already priced into markets. And that's really the important point. Markets are already anticipating tightening, and quite meaningful tightening if you look at New Zealand's situation. Will they actually deliver on that? Maybe. Will they deliver more? I'd argue the risks are skewed to they actually probably won't need to deliver as much as priced in. And that's a backdrop still supportive of equities, and actually eventually still it gives you more opportunities in your fixed income portfolios as well. So I know that's a really long-winded answer, but I hope that covers it off. It is a really, really important topic, and thanks for your question.
And just to follow on from that, where do you expect interest rates to settle out? Obviously, we've already had some intervention. We're obviously going to see a higher rate going forward for the medium term.
Yeah, so if you look at this, let's start with New Zealand. The market's currently pricing the official cash rate to get to around 3%, or just north of 3% by kind of almost this time next year, middle of 2023. Now that's relatively low based on history, but given the structural change in the New Zealand economy around debt levels and things, that will bite, I believe. And you're already seeing anecdotes, at least, on the housing market, and consumer confidence and business confidence have taken a hit. Now, there's other forces driving that too, of course, not just interest rates, but I believe that it won't necessarily take that much degree of tightening to see the economy cool off. When you look around globally, markets are pricing the US federal funds rate, so the equivalent measure in the US, to get to around 2%, again, on a roughly similar time horizon. So though, again, those sound low relative to history, but I actually believe that's more or less enough. When you look at the risks around the world still, and look, I hope this is not the case, and hope is not a way to invest, of course, but if the situation does escalate in Eastern Europe and we see energy rationing in Europe and potentially in other parts of the world, then that will have growth consequences. And there's no way central banks will tighten in that environment to the degree that's priced in. So there's clearly risks on either side of that. But I just think, the degree of tightening necessarily relative to history won't be as large as if you look back in, say, the 90s or things like that.
Tania, then Lloyd. Thank you.
Thank you, Chair. I just wanted to probably highlight or draw Council's attention to two words in the report that we've been given that come through in the monthlies: strategic allocation and tactical allocation of funds. We are a capital conscious investor by definition within the JB Ware definitions. So we're a long-term investor and we have a 50-50 portfolio. Just looking today, the Dow and the NZX are down 10 and 11% respectively from the 1st of January, and our portfolio is down 5%. So that strategic allocation is working for us. And what these gentlemen are talking about is the tactical allocation, which is the little bits around the side where we go 1% here and 1% there either way, or a couple of percent. At the end of the day, I think it's clear that our portfolio is doing what it needs to do, which is the most important thing. We don't have a need for cash in the short term. We, I'd like to say, improved our liquidity position in the last 18 months, so that we're not in a position where we need that cash today. So I just wanted to highlight that. And I did have a question for Phil. I'm old enough to remember somebody standing on a stage somewhere before the internet saying something about they were hoping for a soft landing. I don't actually remember who it was, and I probably wasn't that interested at the time, but can you tell us historically, did that happen, and how did the markets live through that?
Which period are you talking?
So it's a while ago. Bruce might have to answer that one.
Well, I suppose, if you look back at economic cycles, if you're an investor, and again, for Environment South, and your point's a very valid one, Tanya, around you've kind of got a very balanced portfolio, capital conscious. But if you look at, this other call coming through. If you look at investment portfolios, it's your equities or your growth portion of your portfolio that's going to have all the volatility. And the performance of that part of your portfolio is largely determined by how strong or weak the economic cycles are. So if economies are strong, corporate earnings are strong, equity markets are strong. That's kind of a nice golden rule to think about. Economic cycles are determined by lots and lots of different things, but the most common factor running through history is how central banks behave. So if central banks have a history of kind of when they get really, really worried about inflation, they'll hike aggressively and effectively engineer a growth slowdown, in most cases a recession. And that's when you start to get, well, you want to be nervous, but prior to that happening. So there are certainly situations around where central banks have managed to engineer that. So in the mid-90s, the Fed was tightening and it didn't necessarily cause a sharp recession. But then there's other examples, say just ahead of the global financial crisis, where there was also a credit bubble, but where inflation just proved so persistent that central banks effectively had to put a stop to growth to get inflation down. Now, our view this time around, given what's driven inflation, is kind of beyond central banks' control, and no matter where they set monetary policy, inflation, those things are going to continue to linger or unwind. So yeah, it's really around a strong belief that it's not in their best interests, because of longer term inflation expectations are anchored, to absolutely slam the brakes on the recovery here. So yeah, there are situations where central banks do have to force a hard landing. That's not our view, at least not at the moment, and hence why we're kind of still comfortable with equities exposure.
I'll just slip a quick reply, and I'm not going against you, but being devil's advocate. But to get a soft landing is incredibly hard, and central banks do misjudge, and they do go too hard, sometimes too early. And hopefully when we look back at history, we see with Mr. Powell, the Fed chairman there, he is looking back at history and saying, well, he should do this slow and gradual, but it's always a fine balance to get it right, because there's so many balls in the air to try and get the soft landing, and sometimes you leave it a little bit late. And there'll be plenty of central banks feeling around the world that they've let inflation get ahead of them, and now they're going to have to play catch up. And I hope Phil's right, because he's a very smart fellow and very informed, but it's always a juggling act to get the exact right balance. So the soft landing is always hard to get.
Soft landings are always hard. That's good.
Always hard to get.
Councillor McCallum, quickly, and then Councillor McPhail. Thank you.
Gentlemen, thanks for that, and it's nice to see your portfolios working well, but I'm very mindful that we are at the extension, our main banking portfolio is in Australia, and we seem to have unprecedented behaviours when we're out of sync with the rest of the world from interest rates and inflation, and people come and rest money here because we have this cooked economy. But one of the things I've come across lately is that the world debt is actually very, very big, and especially in the States. What effect do you think that will have flowing back through to New Zealand? Because I think that depending on what commentator you've got, is that effectively we run out of this privilege of going to the bank and borrowing debt. We haven't paid it back that well globally. In our economy now, in the last 2 years, it's probably doubled its debt or more, and it's still borrowing, and it's still got a lot of pressure, social pressure, but we've got no real assets on the ground to actually say we've invested well. So how does their portfolio deal with those sorts of pressures? Or can it?
There's a lot of stuff in that question, yeah. And the thing is with concerns over debt, I suppose fiscal debt, it's a long-term issue. So it's from when you think about how that impacts on portfolios, you've got to think about it in a long-term sense. It only really becomes a concern if there's a crisis that, say, in emerging markets, which have had debt issues in the past. I think it's very rare to think that, or very unlikely to think that you'll see a big debt crisis emerge in the next few years, which is kind of how you'd be wanting to think about it from a portfolio sense. But look, it is very relevant when you think about long-term expected growth, so economic growth, and hence long-term expected returns from investments. So it determines where you think interest rates will settle over the long run. It determines how fast you think economies can grow in a trend sense, and then hence where you think corporate earnings growth will be over a long run as well. So it forms your backdrop around long-term expected returns and the risks around that. So that's, I suppose, from a structural debt perspective, that's how I think about it from a portfolio. But yeah, from a near-term perspective, I'm not concerned about debt levels around the world at all. Interest rates are still historically very, very low. Yes, they are rising, but they are rising from negative levels in some instances, or still negative levels in some instances. So debt servicing levels, which is the metric which is far more important than, say, the level of debt, is still sitting around average levels relative to history. So the servicing of the large stock of debt we've got is actually not causing any strains at the moment. Now that could change in the future, absolutely, if interest rates are forced to rise a little bit higher. But at the moment, that's not something that I'm losing much sleep over. Yes, the debt servicing is still very, very sustainable.
Thanks. Councillor McPhail, please.
Going to add an interesting thought as I was sitting there thinking, 7-year cycles. Probably been in the investment game, we'd understand that we are in that 7th year from the GFC 2008. We have a major sort of clink in the system. And does that take any consideration when you're going back to the 87 stock crash? We're in that 7th year now. I was waiting for it in 2014, 15. Maybe the Ukraine thing was starting to happen there, but it sort of got put on hold. Now we're back to this is the 7th year again. I don't know if it might be a conspiracy sort of theory, but there is actually some relevance in some of these. The world needs to take a check every so often in financials.
Well, the GFC was actually 2008, so it's
it's 2008, but it's 14 years. It's a 7-year. It's in the 7-year blocks. Didn't take it in 2000.
I see that as a
.com was 2001, was it? And 87, then you head back another 14 years. So
yeah, no, I'm not necessarily a buyer of that. I see it as more of a conspiracy theory. There's always things going on every single year in markets, which people say history is repeating itself, and history does repeat itself because the economic cycles and things. But I'm not thinking that because 7 years are up, we're due to have another. So we're monitoring kind of the fundamentals and rather than necessarily the calendar, to put it that way. Yeah.
Thank you, chaps. Interesting questions. I have one, but I might just I'll discuss it with Tania, and we might pass it on to you later because it's not urgent. Would somebody like that to move that we note the report, please? Thank you, Councillor Cook. Seconded, please. Chairman Horrell. All those in favour, raise a hand, please. Thank you. Against? Carried. Thank you. Thanks very much, team. Really appreciate your insights. It hurts my head, so I'm glad that you guys know what you're doing.
Thank you very much.
Thanks, guys.
Thanks, all. I hope to see you in person at some point in the future.
That would be good.
Cheers.
Thank you.
Yeah, bye.
Righto, team, we will move on to item 3, please. The cash flow forecast. Back to you, Tania.
Chair, I'd like to complete item 2, which was our actual investment report. Just check that there are no questions on the document that's in the agenda.
Apologies. Anybody? Fantastic response. Thank you. We'll take that as part of that motion to move that report. Is that okay? Great. Thanks, Tania. So item 3, please. Oh, Jeremy, is this a item 2 question?
it was just, I'm just pleased to say that the decision that the council made that we did alter the SIPA and we're taking the risk out of having, we're trying to protect some of the capital in the years gone past is certainly working to our advantage in regards to. So just giving everyone a pat on the back for that when these things do happen, and we're still holding our own. So it's good to realise some of those things. We make decisions, we've got it right. So it's good.
Great, thanks, Jeremy. Good point. Okay, third attempt, item 3, please.
Thank you, Chair. So presenting the report for the forecast from the 1st of January to the 30th of June. It does look very steep in the past, and then in the next quarter we can present the report through to the end of the the calendar year, and you will see the traditional movement, but always unwilling to forecast it past the end of June because it sort of suggests that we understand the rate and that we would be disclosing in some way the actual forward rates that are coming in. And because that hasn't been agreed, we can't do that. So we're just simply showing the first half of that curve where we go down from January to June, which is naturally we've received majority of our funds in November. Still some rates to come in and normal monthly sort of receipting, but we're expecting to go from a $20 million positive down to a 2.6 million. We explain the cash flow by way of sort of normal business trading, council cash flows. Actually, if I share this just for a minute, Chair, council cash flows here. So cash flow negative during this period. And then our attempt at forecasting the income and expenses of the Climate Resilience and Jobs for Nature project. And that's where we see it. Now we make a comment each time that we are holding funds on behalf of, if that doesn't make anybody too dizzy, me going up and down, we are holding funds on behalf of these projects. $6.9 million is money that is ours and the government's that is committed within that $20 million at that time. And questions?
And thank you. I have Councillor Beard and Councillor McCallum.
Thanks, Madam Chair. So just a question that are these two statements lined up? Has your cash flow lined up with your income statement? And then if what I see in your income statement under the government funded portions under the climate resilience, you're showing that currently at 6 months we've spent 1,951,000, and you're forecasting to spend 5.2 million at the end of 12 months. So you're projecting further expenditure in those projects of 3.2 or just over 3.280 million. Yet when you look at your cash flow, you're saying that you're going to spend 9.4 million on climate resilience. So all those, 500,000, 2 million, 3 million, 3.8 million, that adds up to 9.4 million in the next 6 months. Yet in your P&L and your income statement, you're only projecting to increase 3.2 million. And also, if you look at your surplus, you're projecting a surplus of 7.4 million. If you looked at what the opening balance was, you're saying on your cash flow, it's 5.2 million. So you started with 5.2 million of cash. If you have a surplus of 7.4 million, you should have cash of around 12 million at the end of the year, 12.6 million. Yet you're projecting to have 2.6 million. So is your cash flow aligned with your forecast? Or is that a bit of a guess?
Councillor, it sounds like an audit.
Yeah.
Yes, the reports are lined up. I specifically oversaw this and instructed the staff member to ensure that the revenue statement was the basis for producing the cash flow statement. I would So there might be some timing differences in the payment of the cash here, inwards and outwards, and I can't debate here those exact amounts without going back through them, and I'm happy to do that outside of this meeting. But it's not $12 million. We always get to June at or about zero. In fact, last year we were above zero. This year we might be slightly above as well. In the past, when I first came here, we were getting to zero in April.
Yeah, I appreciate that, Tanya, but yeah, you started off with 5.2 million. If you're projecting a surplus of 7.4 million, and okay, there's some timing issues associated with whether that's accrued result or whether that's how much depreciation is in there, but depreciation is normally your friend as well. I'm just thinking,
Councillor, I think we have to look at the bottom line that's been forecast and take off the profits from the government funded projects. They are not cash profits.
Yeah, but it's cash flow we're talking here. All right, you look at it again. I think it just doesn't look right to me. It looks pessimistic to the point of it can't be right. Or else your income statement forecast is wrong.
Chair, I'm happy with what we've got here, and I'm happy to talk to Councillor afterwards about cash and non-cash parts of our revenue statement.
Yeah, thanks, Tanya. It might be helpful if we just had an explanation / education session as part of a workshop, just so that we can all understand how that all lines up for you, as opposed to how it might line up in a different kind of organisation. Would that be okay with you?
Oh, absolutely. I do think that what's throwing us out here is the government funded income, which is showing as a capital surplus, a paper surplus, and it's not available for us.
Okay, so Councillor Baird, that would be my recommendation in that space, is just that we have a sit down session and work through that with staff, so we all understand how that comes to be. I wouldn't want it to be a 3-day session, just a quick half-hour explanation. Would that be okay with you?
That's fine. I mean, I'm putting obviously some pressure on, but I think we need to scrutinise these numbers. That's
right, and it's really good that we ask the question. So having a comprehensive explanation to all of us on the committee, I think, would be helpful. So Tanya, I'll ask you to add that to the action sheet. Thanks very much. Councillor McCallum, you are next.
Thank you. And just following on, it'd be quite good, Bruce, to have your comments on that and in the way of how it's presented and shown. But my question, Tanya, is the 6-month cash flow is interesting, but it's more the 12-month cash flow, because I think it shows better the variation between June and the deficit and the rate increase, and then the summertime discharge is better than just this. It looks like you've got a heap of money and you've just had a rate collection. So I think the 12-month is actually better, which actually brings out the conversation after that, is that real nasty one, consultants and can't think of the other name for that, are often quite late in the way they send their bills out. So we just want to make sure we're on top of that as a sideline as well. But I think the 12-month is probably more meaningful than the 6-month, even if they're separated by solid lines and dotted lines. There's one's a forecast and the other is actual.
Absolutely, and if councillors are happy for us to put a projected rates increase in there, or then we can go back to doing the 12-month ones that take us through to June.
Bruce, I'd be interested in your thoughts on that, please.
Just before Bruce does, Madam Chair, I'm more looking back where we've been, not necessarily to where we're going, is that 12-month flow.
Look, I possibly, a bit like Tanya, need a bit more thought. I appreciate your point, Alan, and indeed your point, Lloyd, that about the 12-month giving us a much stronger sense of the flows of what we were at. I don't think, I hear the point about the impact of the government flows, but it's just another form of cash in and cash out. And I certainly appreciate our need to be wary that we don't think that any particular cash surplus generated by the timing differences between the government in and out suddenly gives us necessarily a lot of leeway in terms of money in the bank, because we'll have to do it. So we'll have to meet the contractual commitments under the government. So I'm not certain that we should be getting ourselves too upset about that. But I do agree with your point. The only issue is, and this is where I'm a bit short on my analysis, Alan, is you're clearly looking at a forecast, which is a pretty simple one-line column in the financial statements, versus a more detailed projection in the paper we're looking at the moment, which also means where do we start with our opening balance. So I probably need to go back and have a do and get my envelope out and pull over the front side of it, because the back side's already exhausted, just to make certain I understand your figures. But I do think it would be good that we get the answer to that in the way that you've suggested, Lyndall, which is it's on your action sheet, and I'm sure Tanya can come back to us with a proper answer.
Thanks very much. Tanya, would you like a closing comment before we move that resolution?
Yeah, I would, Chair. I think, because I don't want you to leave wondering what's going on. I think I draw your attention back to this line here, operating surplus and deficit for the year. We have an operating deficit of 4.7 million. That's a cash deficit. And we make that up with dividends and some part of the portfolio. And if you add that number and that number together, which are both cash, we're actually cash neutral from one point to the other. This down here is paper. They give us money and we spend it on CapEx, money in, money out. It shows as a profit. So if we start the year with 20 million and end up, we should have 20 million back in January next year. Midway through the year, we don't have the money, and then it comes back.
Your numbers are you've got an 8 million surplus from the government fund, so that's cash.
It's I'm sorry, it's not, and we'll have to have this discussion. It doesn't get to stay with us. We earn the money and then we invest it into the infrastructure. So it's an accounting paper profit.
I appreciate that.
Thanks,
okay, right,
councillors. I think we'll wrap that conversation up, but obviously there's an action point to come, so we can tidy up any of those questions at that time. But in terms of this report, I would like to move on. So would somebody like to move that resolution, please, that we note the report? Thank you, Councillor McCallum. Seconded, Councillor McPhail. All those in favour, please raise a hand. Against? Thank you. Carried. Thanks very much. Appreciate everybody's insightful questions. Item 4, please. Wilma and Rachel, the long-term plan progress report, which loops back to our previous item. So we might need to realign those in the agenda next time. Thanks, Wilma.
Thank you. I'm going to ask Rachel to take us through this report. I'm here to answer questions also, but she prepared it, and I'm quite likely to speak to it if that's all right with you, Chair.
Oh, of course.
Thank you.
Through you, Chair. So this is the 6-monthly report for the first year of the long-term plan, and as has already been alluded to, links very much to those financial results that we've already discussed. So you will recall the new framework that came in with the long-term plan. We've got the 56 levels of service, performance measures and targets, and at the end of the first 6 months, we have 54 that are showing as green or high confidence of achieving by the end of the year, 2 at amber, which is moderate confidence, and 2 at red. Now, you might recall at the end of the first quarter, we had 2 at amber and the remainder at green. So we've seen a slight change there over the 3 months since then. Paul was going to speak to the red traffic lights, but just to talk a little bit, you've got a summary there of the different activities within each portfolio. And you can see for air that the majority of activity over the first 6 months of the year has been in that airshed monitoring and reporting space. The review of the air plan links to the national environmental standards, which have not come through. So there hasn't been work in the policy and planning space. The other targets in that area relate to some research about behaviour change and to the review of the home heating scheme. So one of the ambers is for the review of the home heating scheme because it links to the research that's been done around behaviour change. That's sort of the precursor to the review of the heating scheme. So depending on when that research comes through, that will affect the timing of the home heating review. But it has been fully scoped out. So that was one of the ambers. The other amber relates to the partnership plan or proposed partnership plan for the coastal space, and that's really relating to new staff coming on board and where the priorities have been over the last few months, but looking to contract some support in that space, and so still retaining moderate confidence of completing by the end of the financial year. With regard to Councillor McCallum's query about whether that high level of confidence is likely to stay the same across the remainder of the year, there are, I guess, a couple of pertinent points. The first one is around recruitment. Tanya spoke about the fact that we have had some vacancies, so depends on how those vacancies pan out and contract labour resource, whether that's available to support where we've got vacancies in some cases, as to the delivery of those performance targets. But the other aspect that's worth noting is the targets vary from year to year of the long-term plan, and the first year is very much a planning and preparation year in line with that 3-year program we've talked about previously. So a number of the targets relate to completing preparatory pieces of work such as project plans or preparing methodologies, and so those remain fairly confident that we can deliver those within this first year. So I will hand it over to Paul to talk about the red lights and the catchment operations space.
Just before you go, Paul, I just need to step out of the virtual room for a moment. So, Councillor McCallum, can you just take the chair for a couple of minutes, please? Thanks.
Paul, carry on.
Thank you, Councillor McCallum. Thank you, committee. The red obviously reflects the challenges in the flood management LTP measure. As you know, there's a number of projects that make up that target, some which we're confident that will have been delivered or will be delivered, but there are some which the timeframes are a challenge, and so the red represents that concern. We have found additional resource to come in and support us around project management and project and program management, which is in the building as we speak. And so I'm confident to some degree that we'll get a comprehensive sort of undertaking to move the program into a different colour, so to speak. So that will become evident between now and the next reporting phase. With regards to the scheme reviews, it is as mentioned in the commentary. The team particularly has seen quite a lot of staff turnover, and also the challenges around COVID. I have asked to see if between now and the end of the year, if there's another way in which we can progress that work with the challenges around resource. So I'm still exploring that as an option. So remain to some degree confident that we can try to bring some of that stuff back onto track. But I think it's entirely prudent to signal to OPAC today that those two measures are are behind, and will need some reflection of some resources to go in if we're going to move the colours to an amber or a green.
Welcome back, Lyndall.
Thanks. Sorry about that. Some things do not wait. Sorry, Paul, I missed your dialogue around that, but I'm sure I might have heard it maybe. Nobody's got their hand up, so no questions. Councillor McCallum and then me.
I was going to ask one, but I at that stage I had the chair, so I had the privilege. Paul, I'm probably quite concerned about the physicalness of doing this very important work for Southland against the theoretical stuff, and I thought we were further down the track to getting the physicalness of this project on the ground, which is really good. But so what's the risks that we would lose funding or lose some credibility with not actually getting this stuff done? Because I think we all agree that there are important projects in their own right.
Yeah, so our commitment to deliver the projects in line with the government's timeframe is still the priority, and still the outcome that we're looking to achieve. So the work that I've asked, the work that we're looking at now is to do that and to continue to do that. There are challenges around the level of technical work that is required before that we can actually do the actual work. And so making sure that we're happy with that balance so that we can hit the last construction season with some confidence. So that is a risk, but something with the extra resource that we brought in and the oversight that we've got, that I'm confident we'll get on top of that.
Thanks. I'm happy to wait. So we'll go to Councillor McPhail and then Mr. Robertson.
When we're talking about these climate change, community resilience, obviously the projects, there's obviously 3 times now again. Just in regards to issue with getting the product in regards to maybe some quarries and these sort of things, does this all fall into this same category? Are we looking far enough ahead for have we got the necessary goods, so to speak? And obviously due to the day-to-day stuff as well. That's my concern, is actually these things are going to be one-off major projects, but it's actually the continual, the risk that we haven't got things thinking far enough ahead and things like that. Does this all fall into the same sort of category? So
it's good program management is what you're talking about, Jeremy. So you've got a clear view of what you need to deliver the final result. Yeah, I agree, and I think that, but within that there are some challenges around contractors, available contractors, materials changing. COVID's impacted that to some degree. So what we're doing now is to try to look at the various projects, look at the materials or the technical support we need, and try to forward work that so we can continue to progress these projects with confidence that we're gonna hit that final construction season. So all focus is on that construction season to deliver on it. So the additional resource that I speak about is helping us to check that.
And Lyndall, if I could just jump in there, because it actually, Paul, just the point I was trying to clarify. Firstly, appreciate the absolute honesty, and you've come with a very direct story. So thank you. I think it's really important to help the committee with its work. But I just wanted to clarify. You said it needs additional resource, and Lyndall, I guess I'm thinking if that's the case, the critical question is it mitigates the risk. Do we have a comment about how that can be achieved? So I'm just trying to understand. You have got the additional resource, or you still need it and you don't know where it's coming from. And secondly, with the additional resource, how does that affect the overall budget?
So the additional resource I speak about, we've already secured to help us in the immediacy to sort of respond to the fact that we're reporting that we're slightly behind. So that resource is helping us to provide a level of certainty that we can, that we might need to make some changes or some alterations. With regards to that what was the second question? Was that in regards to?
Well, essentially, how do we fund the additional? How are we funding the additional resource?
So because that's a discrete, resource that we're needing just initially, that's coming out of existing budgets that we've got. Yeah.
Yeah. So essentially, operational budgets. It's not being charged up as a capital item against the crown funding local share.
Yeah, as I understand it, it's separate to the government funding. Yeah.
Yeah. Okay. Thank you. Thank you, Lyndall.
Thanks, Bruce. Sorry, flicking through pages. I would like to change the topic a little bit and go back to the air quality work, Rachel, and the reference to the home heating scheme in the document. I initially read that as the review that we had anticipated doing into the clean air loan scheme, but I'm now thinking maybe that's not it, it's something else. But do you just clarify that for me?
Yes, Chair. So we are intending to bring a full report through to you in the not too distant future around the whole portfolio of equality. But essentially the clean loan scheme forms part of that, and the research, though, we see as a key precursor to that review, and that it's looking at behaviour and what's driving behaviour change across the community, and where emphasis may need to be put going forward. I hope that helps answer.
Yeah, because I think there are some pressures on those clean air loan scheme that we need to address, and we've been meaning to do the review for a while, so hope we can get that fitted in soon. Thanks. Any other questions? Somebody like to move the recommendation, please?
Did put my little yellow hand up.
Oh, sorry, I can't. Oh, it might be the wrong hand. Oh, were you clapping?
Wrong hand. You're left-handed. So.
Oh, well, there you go. Sorry, Chairman.
We're just following on your question about the clean air loans, and it's been running for quite a while. Uptake has not been that high. I think there was also a correlation with insulation, which government's moves have probably changed that a wee bit too. So we'd look forward to getting a report on where that is, whether it's time to terminate it or change it. So, yeah.
Thanks, I agree, actually. And just before we move that recommendation, Rachel, really liked having the précis of key points at the beginning of the report. So thanks for making that happen. Appreciate it. Somebody like to move the recommendation that we note the 6-monthly long-term plan. Thank you, Councillor McPhail. Seconded. Thank you, Chairman Horrell. All those in favour, raise a hand. Against? Carried. Thank you very much. Right. Looking over bits of paper, which I've now lost. Oh, there we go. Item 5. Thank you.
Kia ora all. This is just a reasonably straightforward item to show the statement of intent for Civic Financial Services. Civic Financial Services provides superannuation services to local government, amongst a few other things, but that's specifically what we use them for. We have 33 staff enrolled in the Super Easy scheme to the tune of about 2 million, and 64 who are in the KiwiSaver scheme at a tune of nearly 4 million. There's been a slight reduction over the last year in both number of members enrolled and amounts, and I put that down to staff turnover, which we've previously discussed has been quite high over the last year, and we've had a handful of retirees as well. But I will take the report as read unless there are any questions.
Anybody? Councillor McCallum.
Bruce, you may be able to help me here. I noticed on page 89, there's actually a surplus after tax. Where does that surplus go? If it's a superannuation fund, I would have thought it would have been fully paid out. So I'm surprised there's a surplus. Or have I got that wrong?
This is civil. This is Civic Financial's results, not the results of the super scheme.
Right.
The super scheme will be accounted for separately. This isn't showing the flows of the money they receive from the scheme members and their investment outcomes. This is actually Civic Financial Services as an entity in its own right. So to the extent that it reflects the workings of the super scheme, I would presume an administration income, they're 0.37% now, which is what they're saying their base administration fee will be reflected in that number. So the fact that in the out years, it's moderately reducing the surplus, if that's partly because they're actually extracting less out of the schemes, that's good for our staff as scheme members. Because I think this is the critical thing, and I have to be honest, Lloyd, this is a difficult thing from this SOI. I've always said the critical thing around Civic Financial Services, are they doing it good for our staff? Because that's essentially what it is now. And I mean, you've probably got the key point, but I would just reflect those numbers there on page 89 relate to Civic Financial Services, not the actual success or otherwise of the schemes, which actually is critical for our staff. They don't appear to be extracting more than they need to in terms of fees. Somebody probably could debate that with me if they have a better sense of the other offerings. But that seems relatively modest, I would have thought, in the long run for the operation of Civic Financial Services.
Thank you.
Yeah, thanks, Bruce. That was my understanding. Any other questions? Somebody like to move that we...
Lyndall, you've gone on mute.
Sorry. Moved Mr. Robertson, seconded Councillor McCallum. All those in favour, please raise a hand. Thank you. Against? Lovely. Thank you. Carried. It's been a long day, hasn't it? So let's just box on. I hope everybody else got something to eat, but we'll have a break before we move into public excluded. So just hang on. One more session. Thank you very much. Item 6, the annual activity plan. Tanya, are you going to take us through that?
I can, Chair. Combined effort. So we, as a result of our Chair suggesting that this needed some work, I attempted to group it into something a little bit more logical, perhaps. So we've got our quarterly reporting groups, our annual reporting groups, and as you can read them. We've added in the respective sections or ticks into the boxes that were asked, and the ones that are highlighted, we've either moved them into those areas or we've had to move them around as a result of reports not being available. We would normally have annual reports now for RSHL and Civic. The delay in auditing throughout New Zealand is like we've never seen before. It's quite chronic, and a lot of CCOs are still being audited now, and I think Bruce could affirm that. So, Chair, I just recommend the activity report as you said, and ask if there's any comments or queries on it.
Any hands up? Just give us a quick nod if you think that the changes have been helpful. One thumbs up. Yes, yes. Great. We'll give it some time and see if that if anything, any other improvements, different ways of doing things are required. But I think that makes a bit more sense for everybody. Somebody like to move that then, please?
Look, I'd love to, Lyndall, but can I just express my appreciation to Tanya for gripping up on this. It's looking a lot better than what we had before. So I'd hate to move it without actually physically saying, well done, Tanya, is much better. So thank you very much.
Agreed. So we have a mover, seconder, please. Thank you, Councillor McPhail. All those in favour, raise your hand. Against? Carried. Thank you very much. Why is it turning itself off? I didn't touch it. Can we please move into public excluded for the following reasons, Mel?
Before we do, Madam Chair, can I just elaborate on my comment earlier? I did put a note on the chat. I don't know if people had a chance to read it. I thought a little bit more about my question back on the finance, and I concur with what Tani has said, but I just wonder if in future whether we can have a forecast balance sheet to the end of the financial year, and then that would validate your cash flow statement, because what we don't see is where all the money's going on the capital side. We show a forecast presentation of where on our revenue, but we're not sort of seeing all that money flipping off to the balance sheet to, I guess, pay for the shovel-ready work and as we do it. And so that's probably the gap that I've acknowledged now is where the other 9 million is. But it's gone to the balance sheet to be the asset that we're saying we've built up with the shovel-ready projects. So that's, I guess, if people.
I don't concur with that, Alan. That's the issue that is a weird around the accounting for the those programs to where it would sit. So I agree entirely with your point.
So on your advice, Bruce, actually, is that something, the way that we report that, something that we could discuss in a workshop setting so that it comes through next time?
Let's be clear. Alan is saying in his email that we appreciate that Tanya and the team are working with us diligently and I'm sure correctly. We just are looking for the visibility when we're dealing with the prospective information, and that's all that goes with it. So it's for our clarity and understanding. It's not because there is a problem.
Yeah. Yes, very clearly. Thank you.
For the accountants, Chair.
Okay, Mel, can we please, thanks for clearing that up, Alan, I appreciate it. Mel, can we have the reasons for moving into public excluded, please?
Certainly. Reasons for moving is to carry on without prejudice or disadvantage negotiations, including commercial and industrial negotiations, to protect the privacy of natural persons, including that of deceased natural persons, and to prevent the disclosure of use of official information for improper gain or advantage.
Thank you. Would somebody like to move in that direction? Thank you, Chairman Horrell. Seconded, Councillor McCallum. All those in favour, raise a hand. Against? Carried. Thank you. Right.